Okay, let's jump right into this explainer and take a look at the massive new blueprint Europe is using to finally tame the digital asset ecosystem. For years, the crypto industry has grown at just a blistering pace. But let's be honest, that growth has often been accompanied by some pretty spectacular market failures and totally fragmented, confusing regulations. Well, the European Union has decided to change that narrative completely with a brand new regulatory architecture. And right at the center of it all is something called MiCA. Today, we're going to unpack exactly how this framework operates and how it connects everything from authorized exchanges all the way down to your private crypto wallet. MiCA is a massive shift from the fragmented state-by-state rules we saw in the past. But to really get it, we have to understand exactly what it is and honestly what it isn't. Essentially, MiCA creates a harmonized market framework across the entire European Union for crypto asset issuers and service providers. It finally lays down the ground rules for authorization, governance, how customer assets actually must be kept safe, and it even sets up strict controls against market abuse. Think about it. Before MiCA, a crypto firm might face completely different registration requirements depending on which European country they were operating in. Now, there's one unified standard. Now, you'll often hear people describe MiCA as the EU's all-encompassing crypto law. And hey, that description is useful, but look closely at that quote. It's incomplete. MiCA is actually just the centerpiece of a much broader, interconnected regulatory architecture. By itself, it doesn't form the EU's entire response to crypto-related financial crime. It absolutely has to work hand-in-hand with anti-money laundering frameworks, tax transparency laws, and operational resilience acts to form a complete, solid shield. So here's our blueprint for today's explainer. We'll be deconstructing this framework layer by layer, looking at the new crypto rulebook, setting the regulatory perimeter, protecting assets and operations, tracing transfers and taxes, the 6-layer control stack, and finally, the future of enforcement. Starting right off with Section 1, the new crypto rulebook, laying the foundation. Let's look at the timeline and why all of this is just so urgent right now, following years of rapid market growth. The sheer scale of this rollout is wild, and it marks a definitive shift to active enforcement. We start with the original 2023 legislation. By June 2024, the stablecoin rules went live, followed by CASPA authorizations in December. As we move through 2025, tech resilience requirements activate, along with mandatory machine-readable white papers by the end of the year. Finally, tax reporting actually begins in 2026, before all those national transitions end in July. Basically, after that July date, if a business provides regulated crypto services to EU clients, they absolutely must be fully authorized under this new unified regime. Moving into Section 2, setting the regulatory perimeter, what's in and what's out. Basically, regulators have to decide what falls inside this regulatory house and what stays outside of it. So the crucial point here is that calling something an NFT literally doesn't matter if it functions like a financial instrument. It is all about what the token actually does in practice. Substance over labels. MiCA is essentially a perimeter framework. If a token qualifies as a traditional financial instrument, it's regulated by existing securities laws, not MiCA. So say a company issues a massive collection of fractionalized tokens and markets them as unique NFTs. Regulators are going to look right past the marketing at the actual substance. If it looks and acts like an investment product, it's going to be treated like one, regardless of the flashy label. So how does this perimeter actually apply to stablecoins? Well, MiCA splits them into two types. First, you have e-money tokens, which are pegged to a single official currency. Then you have asset reference tokens, which are backed by a basket of multiple assets, currencies, or commodities. To prevent these from just becoming unchecked shadow banks, MiCA demands incredibly strict reserve management and heavy oversight from the European Banking Authority. In fact, issuers are even prohibited from granting interest just for holding the token. Regulators absolutely do not want these operating like unregulated banking systems. Next up, Section 3, protecting assets and operations, the armor. With our perimeter set, let's look at how this architecture actually protects customer funds and the operational resiliency of the platforms themselves. 50,000 to 150,000 euros. That is the permanent minimum capital requirement for service providers, and it depends on the specific services they're offering. If you're going to hold client crypto assets, you must have rock-solid procedures to record positions and ensure client assets are never, ever used for the provider's own account. But remember, this minimum capital requirement is a prudential safeguard. It is not deposit insurance against crypto price volatility. So if the market crashes, MiCA isn't going to swoop in and reimburse you for those trading losses. Enter DORA, the Digital Operational Resilience Act. This builds right on top of MiCA because tech failures or cyber attacks can so quickly become opportunities for theft or sanctions evasion. This is where we really see that connected architecture I mentioned earlier. Since January 2025, authorized crypto providers are required by DORA to actively manage their information and communication technology risks. I mean, think about it. If a crypto exchange suffers an outage or a private key is compromised, that's not just an IT problem anymore, it's a massive financial crime risk. All right, Section 4. Tracing transfers and taxes, tracking the invisible. Now we need to understand exactly how regulators link real-world identity to on-chain activity to stop illicit finance. 1,000 euros. This number is incredibly important. Under the Transfer of Funds regulation, which is often called the travel rule, if a crypto transfer involving a self-hosted wallet exceeds this 1,000 euro threshold, providers have to take measures to assess if their customer actually controls that address. We all know crypto assets can be divided into tiny fractions and moved rapidly across the globe. Because of that, providers now have to collect and transmit information about exactly who is sending the money and who is receiving it, much like they do for traditional wired transfers. You can't just copy-paste traditional market surveillance rules into the crypto world. It just doesn't work. Detecting manipulation here requires tracking rapid chain hopping because crypto trades 24 hours a day, 7 days a week, across multiple platforms simultaneously. A market manipulation scheme in crypto might involve coordinating a whole bunch of seemingly unrelated wallets, hyping up a token on social media, and rapidly moving those assets across different exchanges. Platforms are now legally required to have systems capable of detecting this very specific type of complex, round-the-clock suspicious activity. And to fully close the loop, the DAC-8 framework ensures users can't simply use these shiny new authorized platforms to hide their income from national tax authorities. Starting in 2026, reporting providers must identify relevant users, collect data on reportable transactions, and transmit this directly to tax authorities. You could have a perfectly authorized provider, but if its customers are using it to conceal gains offshore, well, that's a huge problem. DAC-8 adds that vital, non-negotiable layer of tax transparency. Moving on to Section 5. The 6-layer control stack, your compliance checklist. So how do financial crime teams actually build this complex web of requirements? Let's take a look. Building this out means treating compliance as a unified system, not just a bunch of silos. First, you have to do your regulatory perimeter analysis to figure out what the token actually is. 2, counterparty verification. 3, integrated customer and wallet intelligence. 4, travel rule governance. 5, continuous market and transaction surveillance. And finally, 6, operational resilience. Now, why this checklist matters so much is that the strongest compliance programs are going to seamlessly connect legal entity authorization with the actual human being, their wallet, and their on-chain behavior. Financial crime leaders can no longer look at anti-money laundering as one isolated department and tech resilience as another. When a single transfer of Bitcoin happens, it trips wires across custody rules, travel rule requirements, AML monitoring, sanctions controls, and tax reporting, all at the exact same time. That data has to flow absolutely flawlessly between these systems. And that brings us to Section 6, the future of enforcement, beyond the blueprint. Let's talk about where we go from here, as the EU transitions from just writing these rules to actually enforcing them on the ground. Will this architecture actually stop illicit finance? I mean, this is the ultimate test, right? Institutions must now step up and demonstrate that formal authorization actually results in the earlier detection of criminal networks. Let's be clear, MiCA and its companion rules do not magically make crypto assets risk-free. Bad actors are definitely still going to try to use self-hosted wallets and decentralized services to hide their tracks. So the goal now is all about effectiveness. Can regulators and platforms prove that this massive compliance architecture actually produces stronger protection and catches illicit money faster than before? The crypto market is never static. New forms of decentralized finance, completely intermediary-free platforms, and totally novel tokenization models are literally being invented as we speak. Now, the European Union has undeniably built the most comprehensive integrated digital asset framework in the world. But it does leave us wondering, how quickly will global regulators be able to pivot when the next massive decentralized innovation inevitably arrives?